Do we have a looming recession? So, in this episode, we're going to be discussing whether we are currently in a recession, if there's a recession coming, things that we need to do to prepare for the recession, as well as how the recession is going to affect the real estate market. So, currently, um, you know, there's a couple of things. So when it comes to a recession, I think our economy has been in an affordability crisis over the last probably since the pandemic, realistically. When the pandemic was going on with COVID, there was cheap money flowing everywhere. And right now, I believe that we are in a time where money is not flowing, inflation is continuing to rise, or things are getting more expensive. Car insurance, property taxes, housing or interest rates, the price of food, people losing their job. There's a lot of factors going on with the affordability crisis that we have, which leads people to believe that there is a recession. You know, a lot of people are, losing their jobs. There's a ton of jobs where people are losing. Large corporations are scaling back on jobs. So, what I wanted to go over was the definition of a recession. So, a recession is, I'm sorry. A recession is a period of temporary economic decline during which trade and industrial activities are reduced, generally identified by fall of GDP in two successive quarters. GDP is gross domestic product, right? So, let's see. And if you're watching, of course, make sure you are. If you're watching, make sure you give us a thumbs up so that we can get this pushed out to the YouTube algorithm. And while I'm waiting, while you guys are waiting, do me a huge favor. Do you think we are currently in a recession? Chime in the comment section. Do you think that we're at this stage we're in a recession? Or we just having hard times financially as a country? If you're watching the replay, do me a huge favor and put in the comment section. Do you believe whether or not we are in a recession or what? So while we're waiting in 2025, we have seen a ton of valleys and peaks in our real estate market. And when people think of recession, they think immediately of the Great Recession of 2008, which lasted about 4 years to maybe 2012. And people think about housing. So that recession was spawned by housing. And then, of course, when the banks began to be in a position where they were losing money because people couldn't afford their homes, then there was a great recession where the government was led to jump in and be able to save banks and different financial entities so that they would not fail. And I remember when we went through that recession, the companies like Goldman Sachs and Lehman Brothers, they said they were too big to fail, meaning they could not fail. Because they owned and controlled so many things in the economy, the government could not allow for Lehman Brothers and Goldman Sachs to fail. Reference: if you want a good depiction of what happened on the backside of the recession to kind of lead to things, there's a movie called The Big Short. The Big Short is a movie about what happened during that period of time, with banks. A lot of people seen it as, oh, you know, lenders were just lending to anybody. Realtors were trying to just sell to anybody, even houses that people, technically could not afford. And part of that's a yes, part of it's a no. However, there were products put in place, and I think a lot of people had their hand in the economy crashing. People were just at that point, until the pandemic, we had never seen a real estate market with those amount of sales ever in history of home sales. So people were trying to get people into homes, and it wasn't. So a lot of people think it was ARMs. The ARMs, adjustable rate mortgages affected people's ability because they adjusted and the payment went from 1,000 to 1,500, and they weren't able to afford it. That wasn't just the case. There was loans where you had 80/20s, meaning there was an 80% first, 20% second. There was stated income, low credit scores. Like, there was a cluster of things that allowed for, contributed to the economy and the housing market just busting. I remember I was single, no kids, and I remember being a part of it because I was a realtor, and I was like, I wonder how if things continue at this pace, how are my kids going to be able to afford to own a home? And that was literally what I was thinking, like, man, it's going to be tough for my kids or anyone with kids that are even, not of age to be able to afford a home at this time. So I found it. Treasury Secretary Scott Benton on Sunday said no when asked whether the U.S. was at risk of entering into a recession in 2026. Telling NBC News Meet the Press he's confident Americans will feel economic relief next year, stemming from President Trump's tariff agenda and trade deals. I'm very optimistic. I am very, very optimistic on 2026. We have set the table for a very strong, inflammatory growth economy, Bessemer told moderator Kristen Welker. He also said, we believe healthcare is going to come down, adding that the Trump administration would have news on that front this week. The Treasury Secretary acknowledged that there is no pressure on the economy in certain sectors like housing, responding to comments from National Economic Council Director Kevin Hassett earlier this month. We're starting to see pockets of economies that look like they might be in a recession. Clearly, housing has been struggling. Interest rate sensitive sectors have been in a recession, Bessemer said. Besant said on Sunday. He added that the recent government shutdown, which was the longest in history, also squeezed the economy. NBC News polled earlier this month and found about 2/3 of registered voters said that Trump administration has fallen short on their economy and cost of living. Still, the Treasury Secretary pointed to the GOP's landmark domestic policy package that Trump signed into law over the summer, the president's big, beautiful bill, and to the president's tariff and trade agenda as signed that 2026 will yield a stronger economy for Americans. See what else we got here is some meat. It says, what I am confident on is that this was a display of gross negligence, he said, not answering questions about whether the Trump administration is issuing illegal orders. Again, guys, if you're watching, comment whether you think we're in a recession or we just have an affordability crisis. Again, you know, interest rates interest rates have been coming down over the course of, let's say, the last 12 months. Um, Housing prices have stabilized in most areas for the most part. Still think there needs to be some readjusting in terms of housing prices. But I think there's a disconnect between the buyers and the sellers. I think sellers still think that their house is worth more than what it is and they can get more than what it is. Buyers still think that sellers should go way lower than they are, which in fact, they're kind of right. But at the end of the day, the buyers need the sellers to sell their house, and the sellers need the buyers to purchase their home. So, in terms of recession wise, the affordability of housing is the key. You know, I think that if we can figure out how to make things more affordable, and when I speak of housing at this juncture, when I say affordable housing, we're not just talking about purchasing, owning homes, right? You still people who need to that rent, and rental prices are not going down as much as they're not going down. I've seen some change, make adjustments, but not going down as much as you would think they would need to. In the metro Atlanta area, the average rent prices is like $2,100 a month. But it all depends on what pocket of the country you're in. I've seen small towns in Georgia and in Delaware that were fairly affordable in terms of rent prices, and then they increased. So, housing affordability will help with, the economy. Interest rates going down will help. Do me a favor also, if you're watching this again live or you're watching replay, chime in and let me know, what do you think is more important? Of course, somebody's going to say both. I know already someone's going to say both, but what would you rather see? Would you rather see lower housing prices or lower interest rates? So we're also seeing like record number of foreclosure notices and foreclosures happen. We're seeing a record number of automobile delinquencies happening. We're seeing a lot of people losing jobs, a lot of companies cutting back. We're seeing a lot of things that are affecting people's livelihood, because at the end of the day, if you don't have a job per se, or income, you can't afford to buy a house. And if you're not buying a house, then there's homes that are sitting on the market. Builders have homes that are sitting on the market. Landlords have homes that are sitting on the market because the person can't afford the rent. So if people are losing their jobs and there are no jobs coming, then we need to figure out how to make it more affordable. There's huge layoffs, and then there's huge sectors where there still is room for employment. The problem is people have not been made aware or are not aware of those jobs that are lacking help. So, example, I read a article last week that said that Ford Motor Company says they have 5,000 mechanic jobs available with the average salary of $120,000. He can't find anybody to fill those spots because people there's no one, not saying qualified, but no one who has the experience to work as a mechanic. There's also a need for trades, electricians, linemen, plumbers, HVAC techs, welders. Like, those are sectors that are in great danger of us being shorted. And I saw a statistic that said that, in the next couple of years, because of the lack of plumbers and tradesmen, that they could make in excess of $350,000 a year just because there's that many available jobs. I think the number was like 300,000 available positions. So all of these things wrap into the economy, whether there's a recession, artificial intelligence, aka AI, is taking over some positions, but there's also positions that are still void that we need to figure out how to fill. So personally, I don't know if we've had consecutive quarters of declining numbers, like consecutive quarters, and the term is two consecutive quarters with losses, and they consider recession, but we have to figure out how to make things recession proof. And when I say recession proof, that means you need to figure out, again, it goes back to, we need to get on a strict budget. Maybe we can't eat out 4 times a week. Maybe we can just eat out on the weekends. Maybe we figure out, hey, we can't cook we have to cook throughout the week, and meal prep, and just cutting back on things. Things are getting more expensive, or they're staying the same price, right? So what I've seen, and this is even in housing, builders are not increasing their prices as much, but the size and the footprint of the home has gotten smaller. So yes, you're not paying super exorbitant extra amount of money now, and the price jumps aren't going up as high as they were, but the footprint of the house, maybe it's no longer 2,200 square feet. Now maybe it's 1,960 square feet. So like the footprint of new construction houses are getting smaller, and builders are sitting on 41% more of inventory, and they're offering incentives, and people still aren't biting or buying. So you have where the builders are offering incentives, buyers either can't afford it or don't buy, or looking for rates to continue to go down or housing prices to continue to go down. Then you have sellers sitting on the market with a ton of inventory saying, hey, I'm not going to give my house away, but your house is only worth what someone's willing to pay for. And I think real estate agents need to have a conversation with those sellers and give them some realistic expectations. A lot of people, agents probably take the listing to have the inventory in the listing in hopes that they can get the seller to change their mind down the road. But knowing whether they will or not is all going to depend on the pressure that the seller themselves are under. So guys, we're talking about, is a recession coming? Are we in a looming recession? I think it's an affordability issue. We're constantly still losing jobs. The real estate market is somewhat slowed in certain areas. And now even more so because we're in the holiday season, more people are potentially kind of waiting. Hey, I'm just going to wait until the new year. I'm going to wait till 2026 to do my thing. Right now, if you're looking to purchase, maybe the best time for you to purchase, because if the house is still on the market, the seller is still looking to sell. The seller is still looking to sell. If you're a buyer and you're looking to buy, to me, in my opinion, what difference does it make if you're pre-qualified for you to just pause right now because it's the holidays, and then at the beginning of the year, start looking again? You're probably going to be looking at some of the same houses. Yeah, some new stuff may come on the market, but if you're going where the crowd goes and everybody says, hey, I'm going to wait till the beginning of the year, you're going to be in more competition. I remember 2 years ago, I had a client that was looking, and she said, hey, I know it's a holiday time. I'm going to probably just hold off until the beginning of the year. And I said, hey, why would you wait until the beginning of the year? You won't, if more people are thinking like you, why don't you go against the grain, put in an offer on something you're interested in, there's going to be less competition for you, and you could potentially get the house because you're not competing against anyone, because everyone's in the mind frame of, hey, it's holiday time, so wait till the beginning of the year. And guess what? She got an offer accepted on Christmas Eve. So, as a buyer, in what could be considered a looming recession, here's an opportunity for you to get a house at a better price and with more incentives that benefit you, right? When I say more incentives that benefit you, and again, as I preach, don't always go for the lowering the price. Maybe give the seller close to what they're asking for, and then ask for more closing cost assistance. So, example, I want you to understand that if the seller went down $10,000, that changes your payment maybe $10, $15 a month, if that. That's not significant, right? However, if you take that money and buy down the rate, and let's say that allows you to buy down the interest rate 0.25%, that 0.25% could change your payment $40-some a month, which is a far greater savings for you monthly versus just $10 because you got the house lower. And yes, some people feel good. Oh, I didn't pay full price, but it didn't really benefit you by maybe 10, 15 bucks. Whereas if you gave the seller close to what they needed and asked for more closing costs, then that would allow for you to, potentially use some of that money to pay for your closing costs and buy down some of the interest rate if you can. Again, guys, if you have any questions pertaining to the real estate market, definitely put them in the side. I see you guys joining. If you're watching, do me a huge favor, give me a thumbs up. Let me know, push this out in the YouTube algorithm. Also, if you think, let me know. And Miss Jones, you just joined. My question is, do you think we're in a recession or not? That's question one. Question two is, would you rather see housing prices go down, or would you rather see interest rates go down? And guys, be on the lookout. I finally talked to Shahida. We're going to do a joint live on December the 11th at 7 p.m. Be on the lookout for the advertisement. Shahida and I are going to collaborate on a live between both of our channels. We don't know what the topic is yet, but we just know we want to set it in stone. If you have a topic, and Miss Jones, I saw your topics that you put when you were on her live. So if you guys have an idea what you have questions about, you want to ask Shahida and I, you want to see what we, see what we're going to be talking about, let us know. Yes, we are in a recession. I would rather interest rates go down. I would prefer interest rates to go down. Got you. What else, guys? Hey, it's more people out there. Let me know. I know everybody doesn't always comment, but hey, you don't have to ask a question. Just answer my question. What do you think? Lower interest rates or lower housing prices? I'm team lower interest rates. But I also know there's a potential need for housing prices to go down as well. I think that we'll see that we're seeing a reset. A portion of what the government, the administration is looking to do. They threw out their 50-year mortgages. That was something that they thought may make it more affordable. Again, there are pros and cons to both. Yes, 50-year mortgages would seem like you're renting forever because you would never own the home. That's what people think. But the average person, our parents and grandparents and their parents, whenever they purchased, they may have, lived in a house and stayed there for 30 years. However, that doesn't necessarily mean that we have to. The average person at one point, it was between 5 and 7 years, and I think it's increased to 10 years. The average person stays in the house and moves in 10 years. There's so many different ways that you could potentially use the 50-year mortgage to your benefit. Now, yes, the longer you stay in the house, the more the bank makes, in a sense. But the same way that we talk about paying down that 30-year note in X amount of years, you can put together that same strategy for a 50-year mortgage. So, putting together that strategy for a 50-year mortgage, and paying it down by paying extra could help you save hundreds of thousands of dollars. You could also, I've seen people, and I haven't checked into it, so I'm just quoting what I saw and read, right, my research, that you could take some of that savings from the 50-year note. Let's say it was $250 a month. And because of the way the markets have been, you can invest that money into a market and have a greater return. You could, of course, apply that $250 that you would technically be saving, stretch out to have a lower payment. So if anything were to happen, you can make the lower payment, and then you can go ahead and take that $250 and pay that down towards principal. Or you could use those funds to pay down on current debt that you have, so that maybe at one time all you have is your mortgage, and whatever you were paying on, you could take those extra funds and apply it to principal to pay down on the 50-year mortgage. The con to the 50-year mortgage is you are gaining equity slower because more of the principal, the principal and interest payment is going towards interest for a longer period of time. So to get to that threshold, unless you're paying it down, to get to that threshold to where you are paying, more of it towards principal, it's going to take a longer period of time. So that's another, that's a con. You could also figure out how you can position yourself and this is possible. You could take a 50-year mortgage, qualify for the house, have a long-term game plan. And when I say long-term, let's maybe say 10 years, right? Have a 10-year game plan and be able to pay down some debt, pay off on the house, generate some equity in the house, and then potentially refi out of that 50-year note into maybe a 20-year note, right? Because if you got the 30-year note and you've been in the house for 10, you would be at 20 years left on the note anyway, right? So what you have to understand is, because you go from a 50-year and you've been there for 10, so that technically you got 40 years left, and then you go to a 20-year, that does not necessarily mean that your payment will double. So that doesn't mean your mortgage payment will double. Being able to refinance out, like if it's an FHA loan, or refinance out into a conventional loan, and you no longer have mortgage insurance, that's helpful. So there's so many different ways that you could utilize that 50-year mortgage to your benefit. But at the same time, I totally understand 50 years is a long time. It's a long time to take a look at something. And the other thing is, like, we got to do some planning, some planning of your estate. We have to figure out what the succession plan is for if you demise, you pass away, your family. What are they going to do with the house? Are they going to sell it? Is somebody going to continue to keep it in the family? And they need to understand how to pay down on that mortgage. Hey guys, let me kind of reset the room. I am discussing recession. Is a recession coming? What it really means for mortgages and home purchase, right? If you're watching this live, do me a huge favor. If you have not done so already, give me a thumbs up so we can push this thing out to the YouTube algorithm. If you're watching the replay, do me a huge favor and push it out to give me a thumbs up to push it out to the YouTube algorithm. Also, do me a huge favor. If you have not subscribed to the channel, hit that subscribe button as well as the notification button so you can be notified when I put out some of these amazing videos that I do. I prefer the lower interest rates. Cool. DM Sunshine. Hey guys, if you have any questions, make sure you drop them below in the chat. You drop those questions below in the chat so we can see, so I can answer your questions. And it can be a question about purchasing a primary residence. It can be about refinances. It can be about investment properties. I'm here for you. Whatever you want to talk about tonight, we can discuss. And I'll let you know what I think or what our answers would be, what my answers would be. I'm trying to look up some statistics right quick. So yeah, I found what I was looking for. It says in October of 2025, 36,766 properties have a foreclosure filing. That's an increase of 19% from a year ago. This marks the 8th consecutive month of year-over-year increases in foreclosure activity, according to the data from ATTOM, a leading property data and analytic firm. It says this was 3% from this was a 3% increase from September. Of course, 19% increase compared to October 24. And it says foreclosure starts by lenders increasing by 20% year over year, totaling 25,129. Completed foreclosures where lenders repossessed the properties, and also saw a significant jump of 32% year over year with 3,872 properties affected. The places with the highest number of foreclosures is Florida, South Carolina, and Illinois. While foreclosure activity is rising, it remains considerably lower than historical peaks, suggesting a gradual normalization influenced by current market conditions like increased housing and borrower expenses. So while we're seeing a record number, and I say record number, the highest that we've seen, and we're seeing foreclosures start to increase, they're still at historic lows, which means it's still ramping up, and we're starting to see those foreclosures come on the market or people having issues making payments. And that's, in large part, it is probably not probably, in large part, it's due to the lack of jobs. People losing their jobs. If you don't have a job, if you got 3 to 6 months, if you have 3 to 6 months of savings, that will last you. But if you're on 7 and 8 months of not having a job, then you're going to have a hard time maintaining your mortgage. What I will say is, if you have an issue with your mortgage, the first person to call is your mortgage company to see what they can work out. Another call is to see if there's an agency in your state that help people with mortgage issues. I know that Delaware has some funds. I know Georgia has them, and I'm sure other states do as well. Do you think we are in a recession? I think we got an affordability issue, and I think our economy is declining, but I'm not necessarily sure. Let me say this. I think we've been in somewhat of a recession for a few years. But right now, everything is just hard, you know, to be able to afford stuff. And we're not just talking about affording houses. We're talking about homeowners insurance is increasing, property taxes, the grocery prices. Some things are increasing, some are not increasing, but what is increasing is decreasing is the size. So, if you buy cereal, the cereal boxes have gotten smaller. They were already giving us over a half a box of air. So now we got, even more air and then in a smaller box. Dairy prices are increasing, increase of milk, fruits and vegetables somewhat increasing, not as much, but then, fluctuation of gas prices, increase in, services. So it's so many different things, like if you go out to eat in a restaurant, the food prices have gone up because they've got to make a profit and they're getting the food prices have increased, and then they have to figure out, how to be able to pay their workers and maintain their business. So that's looming. But to answer your question, I think we've been in somewhat of a recession, but right now it's just freaking affordability. Like people just can't afford. Not everybody, but a lot of people can't afford certain things. And we do make room for things that we want and can afford, but we also have to do a better job of budgeting as well. It says, if I could write the mortgage payment, if I could write off the mortgage payment, depreciate, and interest on an investment property, a 50-year mortgage may work. None of that changes, Cynthia. Like right now, you still like I believe that the 50-year mortgage wouldn't change any of that because the tax laws are geared towards entrepreneurs, like business owners and real estate. Those two things benefit from the tax laws more than anything. I doubt it if we will see those things go away. But that, what you said is a strategy, writing off the payment, depreciation of the house, interest on the investment property, a 50-year mortgage may work. And it could, because technically you're not paying the mortgage. And if you purchase it right up front, if you purchase the house right up front, there's potentially going to be more cash flow in it. And you can take that cash flow and kind of accelerate the payoff of the home, because you're putting more towards principal. So in fact, as an investor, that could work to your benefit and still be able to pay the house off early. So when you're ready to retire, you are cash flowing and maybe don't have a mortgage. What is my opinion on the NACA program versus just applying for USDA, FHA, or conventional loans? Thank you in advance. I think what I know of the NACA program, I think the NACA program is a great program in terms of what they look to do, getting into a home technically with no money down. The caveat is, what I hear is the NACA program takes a long time to get through, and sometimes you have to continuously restart because the workers quit. So anything that's free in a sense where you can get in with no money, there's going to be a high demand for it, but not enough workers. The other thing is, like, I had a person say I could never get in contact with my worker from NACA. One is because of the type of job that they had. So if they have a job where they don't have the ability to use the phone during work and they can only use it during lunchtime or when they get off at 5, well, the people from NACA may be overwhelmed because there's more than just them calling, along with their heavy caseload. And then at 5 o'clock, they're typically gone. Well, that person working may be off on the weekends, but NACA's not open on the weekends unless they're having one of those sessions. I'm not going to say not to use NACA, but it's all going to depend on how fast you want to move or get to where you need to go. I've seen people say that they've been in it for 2 and 3 years and they just decide to finally get into a traditional mortgage. Just applying for USDA, which is 0% down. In certain places, you can use down payment assistance with USDA. So you shift that down payment that they were giving you to take care of your closing costs, and it provides a similar effect as NACA. The only difference is, I believe NACA's interest rate would be lower. FHA, same thing. If you can get into a mortgage, with no money down, utilize the down payment, see if the seller can contribute to closing costs, and boom, similar effect as NACA, except the interest rate slightly higher. Conventional financing, the same way. Not as many programs that work along with conventional financing to get you a zero money down, but if you can get low money down and then the seller contribute to closing costs, again, same effect. I guess, this is a good question. All of you guys watching, of course, nobody wants to pay anything for anything, right? But if it was up to you, if you could get into a home with no money out of pocket, would you be okay with no money out of pocket, or are you more concerned with having a lower interest rate? Hey, Kevin, I am in a recession at my house and I would like the price of housing to go down. Sorry to hear that, Miss Debbie, about your about the recession at your house. Let me know if you have any questions as to what you can potentially do to increase some funds in your home. It says I mostly eat plant-based and organic, and it's definitely gone up. Miss Jones, do you have a garden? I'm seeing in my area, and there's a ton of groups online, Facebook groups where people are growing their fruits and vegetables organically at their home because they know exactly what's in them, what they're growing them with, less pesticides, and it helps them save money. And then also they share with people in their community on the overflow of what they have. So somebody might grow tomatoes, somebody might grow cucumbers, and they swap. Somebody might grow thyme, the other one might grow oregano, and they swap. Somebody might be growing corn. So like just kind of, hey, we're growing this. Oh, you're growing that. And then, hey, I've got some extra this and that. And then I know one organization that has like a community garden, and they take whatever they grow and they give it to the food bank. Thank you, Miss Jones. I appreciate it. Okay, you live in an apartment with no outdoor options. Got you. I would have picked no money down just to get into a house quicker. It says, I tried the herbs, they died. I mean, last year I grew Last year I grew thyme and broccoli. It was my first time doing it, so it went pretty well. It's just a play on words. I needed more time so I could do more vegetables. I didn't get a chance to plant anything in the spring, and I think I'm too late right now. I'm actually going to check. I got a little bit behind schedule. Lower interest rates. Do you think interest rates will be low enough for recent buyers to refinance next year? That's a great question. Possibly, possibly. Depending on what your rate is now. So, do I think that rates will get into the fives or low fives? Probably if you buy them down, which is possible, which isn't as expensive right now. But so this is one of the biggest misconceptions about refinancing. I'm going to ask a question before I do it. What is it worth to you to refinance? Meaning, how much, two questions. How much do you think you would save, or are you looking to save when you refinance on your home? So there are some big misconceptions. And when people go to refinance and they find out that they're not going to save as much as they think. When you refinance, if you're looking to refinance, how much are you potentially looking to save? And are you looking over the course of time, saving money over time? Or are you looking at immediate hit of the immediate hit of savings? Miss Jones. I don't have any social media, but all those things are great. Wish I could take part. I mean, Miss Jones, you could potentially, I'm not sure where you are, but you could potentially check out your community. A lot of communities have community gardens. When I say community, maybe, Google, like I live in Georgia, community gardens, something to pop up online. So that doesn't necessarily mean you have to be online. They do meet in person, and I'm sure there's people who don't have social media either. So you could at least look it up and find out, and take a part in that as well. So 500 to 1,000 a month, and let's see what else we got. Wouldn't it lower the monthly payment? Yes and no. Potentially, yes and no. So I'm gonna answer that first question first. So is the goal is when you're refinancing is to try to obtain a lower interest rate so you can save money on your monthly mortgage payment. If you're not looking to take out cash, a rate and term refinance is going to be one of the least expensive ways of lowering your monthly payment. The interest rate changes. Let's say you go from 6.5 to 6. Small tweak, but the amount that you save is determined by how much mortgage you have, what your mortgage is. So saving, like example, if your monthly mortgage payment is $2,000, it's going to be hard pressed to save 500 to 1,000 because you probably purchased a $260,000 house, maybe 300,000. Like to save $500 a month, your mortgage payment, your interest rate would probably have to be cut in half. So if you got a 6.5% interest rates would probably have to be 3.25% to see that drastic of a jump. So the big misconception with refinancing is that you're going to save hundreds and hundreds of dollars on your refinance. Because of housing prices increasing over years, that impact of a refinance isn't as significant as it once was. I'm not saying that it doesn't make sense to refinance. I just say, hey, your expectations of saving a ton of money is not going to happen unless you're looking at, let's say you did a bank statement loan. Let's say you did a bank statement loan and you had a higher interest rate, and let's say it was 9-10%, and then you refinance from a bank statement loan into an FHA conventional loan. You're going to see a good savings there, depending on how much the house is as well, right? At lower price points, you're not going to see as much of a shift in what the monthly mortgage payment is. But if your mortgage payment is if your mortgage is a $300,000 balance and it appraises for $450, and you say, hey, I want to take some cash out, yes, you can lower the interest rate, but taking that cash out will increase what your balance is, and then your payment still may not have as significant of a payment drop as you expected. The other part to that is some people refinance because they need a reprieve on payments. Yes, I'm only saving 30, 40 bucks, let's say 50 bucks a month. It's 50 bucks a month that you save and you can shift somewhere else. But those 1 or 2 months that you don't have to make that $2,000 mortgage payment plays a part as well. So you save $4,000 just off not being able to refinance, not when you refinance, not being able or not having to make those 2 months of payments. So it just kind of all depends. So the average refinance saves the person $100 to $200 a month, unless you had a high interest rate and you refinance when rates got super low. And it also varies too. Like it could be interest rates are lower. You go from an FHA to a conventional loan. You have 20% equity in your property. You get rid of mortgage insurance. So there's a lot of different factors into that. So yeah, refinancing is not what most people think it is. And once they're explained and understand what that is, then people begin to get an understanding. The other thing is, hey, well, can I just buy down the rate? Yes, you may. But if you don't intend to stay in that house for 5 to 7 more years, it's not worth utilizing that money to buy down the rate, because you'll never recuperate what you put out into it. Again, hey guys, Miss Jones is right. Please like this video. We are talking about a recession, what it really means to your mortgage and home prices. We're also discussing refinances, and one of the big misconceptions is you saving a ton of money on refinancing. Miss Jones says, I'm going to get my snacks and ready for my Ratchet TV. Good night, everyone. Thank you, Miss Jones, for joining. What impact do you see happening to the housing market in the U.S. next year due to the World Cup happening in North America? I think that you have a great opportunity if you own rentals to make in wherever they are to make some money, because people are coming to those cities in those states. I think we may see a spike in the economy wherever we are. right? If you're like, for instance, they're coming to Georgia. So in the Atlanta area, people are going to be making money. Businesses are going to be making money. I seen somebody told people, hey, I would start a business just because the World Cup is coming. So I think it'll have an economic impact on some houses. Some investors. There's going to be people who pick up properties ahead of time or slowly picking up properties so that they can have them available and make a bulk of their money during the World Cup. Other than that, I think it'll have more of an impact on the economy itself versus the housing market, because think about it, after the World Cup, where you can charge a little bit more and, make a good amount of money in that month or whatever the time frame is. But, after that, you still have to rent out the house. You have to do, whether you're doing short-term rentals or corporate rentals or, long-term rentals, you have to have a game plan. Trump has been in office less than a year. The Biden administration lasted for 4 years. Yeah, not sure what significance that is to anything we're talking about. Um, Housing prices. Um, I plan on buying next year. I'm afraid the competition will get tough, be through the roof, do that time. I, you know, it just depends. So what is your barometer of purchasing next year? And I'm asking, not to challenge you, but asking because I always wonder what people have going on to push it out a year. Sometimes I hear people say 2 years. Sometimes because they're waiting for the kids to get out of school and they don't want to switch some school districts, but they don't want to live where they are because it's like, hey, I'm here because the school district's great, but when my son or daughter or my kids get out of school, I want to move somewhere when they're going to college. So that's my question. Why next year? Just wondering. In competition, I think they said for every 0.5%. Let me look it up right quick. I gotta find it. Let me look at some research right quick. What percentage brings in more buyers? Huh. Hey guys, we're gonna be wrapping up here soon. So if you have any additional questions, do me a huge favor, put them in the comments. If you have not already, please like this video. If you're watching the replay, make sure you like the video and share it with a friend. And also chime in and let me know, hey, do you think we're currently in a recession or not? And also, would you rather see housing prices go down or interest rates go down? Uh, uh, So if there is a 1% decrease in interest rates, that brings out 1 million more buyers into the market. Says kids and hoping prices go down a bit. Got you. Okay, that makes sense. No problem. Hey guys, I appreciate you jumping on with me tonight. If you are following me and you like this channel, do me a huge favor, give me a thumbs up. Please share this out with anyone you think it would be helpful to. My contact information will be in the description if you want to reach out to me. I'm Kevin Jefferson, the People's Lender. Have a great night.